recording now. So Tarek's with us today. Hi, Tarek.
Hello, everyone. Thanks for having me over tonight, Sam.
Thanks
More
for
than
taking it.
more than happy to help you out with these sessions.
Yeah, awesome. Really
Um,
appreciate it.
oh, you're very welcome. Just for those of you who don't know me, my name is Tarek Soufan. I am a chartered investment manager with Freedom 55 Financial. Over the last 12 to 15 years now, I've been involved in financial services in some capacity. I've worn various hats over my career. I started out as an equities trader, funny enough, with Sam. And then my career evolved into a financial advisor in 2009. I worked a couple years at CIBC as a mortgage advisor, and I'm back at Freedom 55 since 2012. Um, I do quite a bit of mortgage business through the Freedom 55 channel. Sam has asked me to come in tonight and just talk to you guys about mortgage lending and some of the ins and outs to help you move your deals along. So we've come up with a mortgage financing program. I think Sam touched on
Yeah,
some
I
of these
went through
items
this
here.
with you last week. If you don't have the file, it's right there. That's the file we'll be using. You can see it on the screen, um, right there. You can just download it, and when everybody's got it, or when you're ready in a few minutes, we'll get that started, and we'll share my screen and be able to see it, and we'll walk through it. But Tarek, I was hoping maybe if you had some time, tell us to talk about uh, yeah, also talk about maybe shareholders insurance for
Sure,
corporations.
sure.
Anything else that you think that is important as an investor dealing with real estate and setting up those businesses? What we could do to better protect ourselves, and what products that you could talk to us about that would that directly affects how we invest and the best way to invest. Is that
Yeah,
possible?
no, I'm more than happy to do that.
Good, good.
First thing I want to touch upon are the traditional mortgage lenders.
Okay,
Now,
here, my apologies, Tarek. I'm just going to share. So everybody's got the file open now, yes? So I'm going to start sharing my screen. Okay, so questions are going to be down here so you can see them.
if you want to scroll down on that page for me.
Scroll down. Okay.
Yeah.
Everybody see that okay? Good, good, good. Okay. So,
So the points that we're going to touch upon in tonight's conversation are number one, mortgage lenders, mortgage insurers, the five C's of lending, credit reporting agencies and your credit score, mortgage underwriting, and mortgage programs. The first thing I like to touch upon is the mortgage lenders. Something that I've come across over the last few years is with those new stress test rules, for any deals that you have that may not be approved with a traditional bank or a traditional lender, credit unions don't have the same stress test rules. So if you're applying for a mortgage um, through a traditional bank and they're applying those new stress test rules, and in the past, if they were going to qualify your mortgage, they would qualify it at the rate. They would qualify it at the 5-year rate that you would actually be paying, whereas nowadays they base it on the 5-year posted rate, which is usually 2 to 2.5% higher. So if they have to approve you at a rate that much higher, you're not going to be approved for the same amount of value of the home. But it actually reduces the amount that you can borrow tremendously. Well, with the credit unions, they don't fall under the Bank Act, so they actually don't have that stress test rule. So if one bank or one traditional lender closes a door, using a credit union is a viable option for you. If you don't want to go through the broker channel and you want to keep a good rate and not have to pay fees, then using a credit union is a good alternative. Along with the credit unions, you got insurance companies now in on the business as well. Manulife and London Life are offering mortgages. I believe Investors Group also offers mortgages. So between the banks, the credit unions, the insurers, the B lenders, and the private lending, there's a whole plethora of options for you guys if you're looking for lending solutions. Mortgage insurers, if you want to get that from me, Sam, scroll down. So there's with the mortgage insurers, and we've got the websites there for you if you want to get familiar with some of their programs. We've got three players in Canada: Genworth, which I believe used to be or may still be owned by General Electric, CMHC, and Canada Guarantee. Canada Guarantee is one of the newer insurers. They offer unique programs. They offer some really good programs for immigrants. But the websites are listed there. Get familiar with them. Another kind of cool or an inside tip. Um, I had a deal not too long ago that wasn't that we couldn't approve using the traditional underwriting criteria. So for those of you that are familiar with the ratios, um, I had a client whose ratios were at about 39% on his GDSR, which just means basically the amount he was paying on mortgage and pre-tax and sorry, the amount he was paying on his mortgage and property tax exceeded 32% of his income. And the rule is anything over 32% disqualifies you. Well, CMHC does have another option for you. So for those that want to pay 20% down payment and still have the insurance and pay for the insurance out of their own pocket, CMHC will lift those guidelines from 32% to 39%. So if you're willing to pay a small CMHC premium, you can actually extend your GDSR from 32% to 39%.
But you got to put 20% down.
You got to put down 20%,
Okay.
and you're on the hook.
And
You're
right.
paying the CMHC fees now
instead of the
lender,
Right.
right?
Okay.
But it's not the standard 3 or 4%. It's a much reduced rate. I think it's about 3/4 of 1%.
3/4 of 1%.
Right. The number
attached to the mortgage
That's right.
for the term, for the amortization. Well, the term, really.
Correct.
Now, does that extend beyond the term?
Well, it's a one-time fee attached to the mortgage.
Right.
It's attached to the amount that you're borrowing.
To the whole.
To the whole
25
amortization,
years, so
correct.
Yeah. Or I can pay that up front. I can pay the whole amount.
Yes, you can.
Right.
Yeah,
And
you
then
don't. That's
that
correct.
would be less than the 3/4 that I'd be paying over the 25 years.
Absolutely.
Right. Okay. Okay. And do you have any idea, like roughly, is there what was it? What would I be paying on say a $500,000 mortgage with insurance? I mean, its ratio is too tough to say, right?
It's probably in around $3,000.
$3,000. Okay,
Right.
so I could just pay the $3,000 up front. Now the insurance is covered,
Yeah.
right? And typically, a bank would pay that. Every loan's insured.
Correct.
Every loan. So the institution, when I put 20% down, the institution pays that insurance.
That's right.
They waive that cost.
It's a no-brainer for them because they
Right.
want that insurance.
They want the insurance.
They want
right?
the insurance. They want it
Default
so
rates
much.
are pretty low in Canada.
They are,
Yeah.
but they want it so they want the protection so much that they're willing to pay for it.
Right, because you're putting 20% down.
Exactly.
So they've taken the risk. You've taken the risk away from them.
Correct.
Because 20% down, the market would have to dip more than 20 for them to be.
It reduces the risk
Okay,
substantially.
makes sense. Makes sense.
But I mean, so if you ever come across a deal like that where, and not all lenders know about this. That's the So if you're armed with that knowledge, ask what your GDSR is if you ever declined, and if it's if it's under 40, chances are, and if you got 20% down, you can get this approved by using this method.
Okay,
So you're basically telling the lender that you're willing to pay for the CMHC fees over and above the 20% down payment.
okay, right.
And by doing so, you extend the ratio from 32 to 39%. That extra 7%
Right.
gets you that much more buying power.
Buying power for
the
affording
purchase.
more house space.
You got it.
For affording and the in the way, I guess, for an investment property, it'd still be 20% down anyways. So it would be if you're holding the loan yourself.
And so not all investment properties require the 20% down payment. So if you own a home and you want to buy a second home as a rental property, you don't necessarily have to identify it as a rental property.
Okay.
I have a client who has a home in London. He works in Windsor. He bought a second house in Windsor. He moved back to London, bought a third house in London. He's got 3 mortgages with us, all at 5% down.
Wow.
Right?
But he initially intentionally, like he was
Yes.
using them as residents. Right?
Correct.
So that's the main difference. Right?
Correct.
I mean, once you get the mortgage, nobody cares.
Nobody
I
cares
mean,
what happens
so
afterwards.
you can move and nobody
Yep.
says anything.
And you
And
can-
nobody really cares.
Nope.
The banks wish they could do it for everybody, really. At
That's
the end
right.
of the day, they don't make any money unless they give out loans. So yeah, that makes sense. So the 39%, allows me to buy more house, as long as I'm willing to put 20% down and pay the insurance cost up, which I don't have to pay up front.
Correct.
But I'm paying for it where the institution would pay for it typically. Okay, that makes
That's
sense.
the recap.
Okay.
The next point we're talking about are the 5 C's of lending. This is probably the most important part of the whole lending and underwriting criteria. So the 5 C's of lending are capital, collateral, capacity, character and credit worthiness. So just to touch upon some of those, so collateral is the actual asset itself. Um, so if you're buying a home, is it a decent home? Is it in a decent area? Just because I mean, not all lenders are going to lend on properties if they're not the ideal property. I had a deal here in the East End. It was a former go-op, and they had no interest in it whatsoever. Right? So you got to be careful of the nature of the property itself and things like that. Right? So that's the collateral portion of the 5 C's of credit. Capacity is your ability to earn a living. So how much money are you earning? Because every lender uses the same ratios, and if your income isn't substantial enough to cover to service the debt, then you're not going to get approved. So capacity measures your ability to service the debt. It's basically your income. Character is as it sounds. It's your character. So I have a client right now who's 20 years old, fresh out of school. He's applying for a mortgage with us, and he's only had his job now for 6 months. Saved up some money for a down payment, but it's going to be hard because he's fresh out of school. He's got 6 months behind him. The lender is looking for a little bit more stability. They maybe want to wait an extra year. So, character is important. Are you somebody who's flipping from job to job? Do you have a history of not paying your bills on time? Things of that nature.
So in that example that you said about him being out of school working for 6 months, if he put more down, if he put the 20% down, would it be overlooked? Or still, that would be a challenge, even though he has lack of a history.
They'll usually want to see 1 year under his belt.
1 year, okay.
Yeah, now not all lenders will close that deal, but majority will. You might have to go to a few different mortgage brokers and speak to a few different lenders before you get something like that approved. It's not that you can't get it approved. You can, but it's one of those harder deals to repay.
I was going to ask you about you were talking about CMHC. We were talking specifically about CMHC, but so what about Glenworth, which is another insurance company
Yep.
that insures mortgages? Do banks ever use those guys?
Yeah, so I mean, a bank has all three at their disposal,
Okay.
and depending on the deal, 9 times out of 10 they go to CMHC. But depending on the deal, if it's a harder deal to approve, and some of the programs they have at Genworth and Canada Guarantee are a little bit more relaxed, and they have some unique programs, especially with the ones for immigrants, a bank will go to those insurers when they need to.
And the rules that apply to CMHC apply also to Glenworth
Genworth and
Genworth
and Canada Guarantee.
and Canada Guarantee.
Right.
Okay, so they're mandated by the federal government. They can't get
Yeah,
around
but the
that.
only difference is Genworth and Canada Guarantee
Are
are not crown corporations.
No, they're not, right?
Right.
So that's what I'm wondering. Genworth, if I go to Genworth to get the insurance, are they gonna, because they can't insure the loan, CMHC won't insure the loan unless you meet all the criteria, right?
Yeah, so you could potentially go to Genworth. Like
Right.
they have a good program at Genworth called the Alt-A program, and the reason why we've got those websites up, folks, is we want you to visit those websites and look at the different programs. The Alt-A program is intended for self-employed individuals who don't declare all their income, but lenders know the income is there. So for a construction worker or a hairdresser, somebody earning tips, somebody who's making 70, 80 grand a year, but only indicating they make 20 or 30, they have programs for self-employed individuals like that.
So they look
Through
at what
through
you
Genworth.
have. They look at what you have in your company.
A, they look at what you have in your company, and
Plus-
B, as long as you have good credit and you're putting a substantial enough down payment, they will take your word as your income. So if you tell them my income is $80,000 a year, you don't necessarily have to prove it by way of notice of assessment. So if your notice of assessment is only showing 30 or 40 grand, which you're in an industry or a trade that the typical person makes 80 to 100 grand a year, for example, a construction worker,
Because
who writes off all his equipment
Right.
and shows very little
Right.
income, they know that the framer is making 80 grand a year, but he's showing 30.
Right, because he's writing off all those things, the day-to-day stuff,
Mhm.
and it makes their income come
Right.
down from say 80 to 30
Right.
because they've used the money to
You got it.
run their business.
I had a
There's
hairdresser.
obviously crossover.
I have a hairdresser who works out of her basement. She shows less than $28,000 on her notice of assessment, but she's showing $50,000 to $60,000 through her bank accounts. Tell us how much she makes. She said she made 60. Just show us a couple bank statements that indicate that you're making on average, 4 or 5 grand a month. And that was all it took.
So they're looking at your gross income. versus your.
Well, they're always looking at your gross income.
Okay.
But in this case, the
So the guy
inc-
says the construction worker says he's making 80 grand, right? Does he have to show that he's
not necessarily, right? It depends on the deal, right?
depends on the deal?
All you have to do is if it's believable. So if your credit is good and you're putting enough a big enough down payment,
What does that mean? Big enough down payment?
so you're
20%,
the Alt-A program I think just requires 10%.
10%. Okay.
It changes all the time, so you have to double check with Genworth.
Okay.
But
So
basically, I mean, you can't be a construction worker and say make $250,000 a year.
right.
But if you're a framer or
If
a
the
carpenter,
industry,
right,
if
and
the industry is
they
less than
typically
average.
make $80,000-$90,000
Right,
a year,
right.
but you're only showing 30 because you want to hide the money from the tax man,
Sure.
and
Well,
you can
not
just
hide. We don't want to. but the way you're
well, that's how these
forming your
guys do it. That's how
finances-
these guys are doing it, right?
Right,
They're
right.
not necessarily paying it. They're not paying taxes on all their income,
Right.
right?
And they believe obviously that you have the capital to do it.
Right.
It's the moving the numbers around to make it work.
What happens is when we're verifying income, we're very strict on the source of verification. We need the notice of assessment.
Right.
We need to see the T4. We need to see EFTs into the bank account or some sort of pay stub.
Right.
But with a construction worker who's getting paid maybe under the table, or maybe he's working for a relative, or maybe he's just, at the end of the year he's saying he makes $30,000 a year. Well, that guy's going to have a hard time proving his income.
Right.
So the Alt-A program relaxes the rules on the income verification.
Wow, okay.
We don't need the notice of assessment.
Right.
Tell us how much you make.
And show us some evidence.
And show us just something that kind of indicates,
Couple
okay,
months.
yeah, show us some, just show us your bank accounts for a couple. Pick, just say a couple months. Pick your 2 best months type of thing, right? Because you can't hide all your money.
Right. Okay.
That's basically it.
Okay.
So,
Well, interesting. Okay. So they're an insurance company, and as long as with CMHC, and they're another option for insuring mortgages, and the insurance portion is important. It's like a house. When we buy a house, if you can't get insurance, you can't get financing, right? Just period. No one's going to give you finance without insurance. So the insurance portion of the house is important in reference to the financing. That's what allows it. It's the same thing with these mortgages. They want to give you the mortgage, but if they can't insure the mortgage, if the insurer won't allow it based on the criteria that you put forth to this client, you can't get that loan. They won't issue the loan because all those mortgages have to be insured. They have to. So that's how important that insurance is and how they play a part, right? It's a big part that they play. I mean, in what loans get approved and which ones don't, right? And is the underwriting done? How's the underwriting administered? So I go to the bank. My GSR, say my gross rent GSR and my TSR are all in check, and they send it to an underwriter.
So the underwriter looks at the deal. He needs to send it to some insurer. So he's going to take the deal, send it to the insurer. Once the insurer gives him the approval, he's then able to approve it. If the insurer is not giving him the approval, so the underwriting has 2 phases: the insurance underwriting and the lender underwriting.
So what if would it be possible for the lender to get a loan that can be insured and still not want the loan? That probably doesn't happen that often, right? They want to give you the money.
They will, of course, they want to give you the money.
Right, so really they're meeting the rules and regulations of the insurer is really what's happening, right? Because they want to issue the money. Okay, I don't want to go too far off track. That was just was interesting to understand the importance of the insurance of these insurance companies in Canada that insure these loans. But going back to the 5 C's, so the first thing that the banking institution is going to look at is my gross debt service ratio, correct?
Correct.
Okay, and I need to be, the standard is 32.
32.
And my credit score needs to be 640.
Correct.
And then I got to meet the other requirements, which the 32 represents my gross income versus the expenses that are associated with what I already have
So
and the purchase.
So the GDSR is strictly your property tax, your mortgage, and any condo fees, if there are any condo fees, and heating. That's
Okay.
it. So heating, we use a standard $100 a month for heating.
Right.
So that's $1,200 out of your income.
Right.
So let's just use a standard. I make $100,000 a year. We're saying that you cannot spend more than $32,000
Of your gross income.
of that $100,000 gross on property tax, heating, condo fees, and the mortgage
and the
payment
mortgage.
itself.
Okay.
Okay.
So they're
And
not
that mortgage payment is not the actual mortgage payment that you will be paying. It is based on the theoretical mortgage payment at the posted rate.
So okay. So that's those
That's
were
the
the
new
new
stress test
rules.
rules.
Yeah,
You
the
got it.
stress test rules, which
So if you're
basically was supposed to tell us that the Bank of Canada, the federal government, was planning to raise interest rates. Bank of Canada was planning to raise interest rates. They were concerned that the interest rates being low, prices being high, that there would be a shock. Imagine living in Vancouver or Toronto, and if your interest goes up 1% even on a mortgage when you renew, and all our mortgages in Canada are considered pretty much ARMs, which are adjustable rate mortgages. Those mortgages are only good for 5 years. It's gonna reset. You have to renegotiate your mortgage, and the rate goes up 1 or 2%. That would be devastating for someone who had $1 million mortgage. It would just crush you because no one's saving an extra $2,000 a month just in case that happens. This is why the government did that. So when you talk about the bank rate, the posted rate, so on average, you would say the difference between the bank rate and the actual rate is roughly
2%.
2%. So 2% extra,
You have to be able to
qualify,
afford.
right?
Yeah, you have to afford.
And that needs to meet the 32%.
Correct.
So you
32% with an A lender using a standard vanilla CMHC rules.
okay,
Okay.
so you've got 32, 39, and 36. I understand 39. That's with me paying CMHC and large
Correct.
amount. What's the 34 for?
On an exception basis. So
An exception basis.
if you're at 32 and your credit's right at 640 and you've only been employed for a year and a half, they're not going to budge over 32. But if you've got a great career, you've got great credit, they'll go as high as 34 on an exception basis.
Okay.
It's not
Okay.
standard, but if you massage the deal a little
Sure,
bit and you ask
sure.
CMHC to go to bat for you, they'll
Sure.
do it. And you got to remember, I mean, at the end of the day, you could always call CMHC and say, look, I've got this deal pending, yada, yada, yada. Give them a story and a song and dance. I had a deal once that was 60% GDSR,
Wow.
but the guy was downsizing and he was moving from a nice house to a condo, and he wanted to pay off all his credit cards and pay off all this debt with the move. So because it made sense, they allowed the deal to go through.
Right, because they knew that
They knew everything
that
was
the
good.
debt that it would be, the ratios would be different after he sold the house and bought the new one.
Correct.
He'd have all this extra money to wipe out the debt.
You got it.
I see. Okay.
Right.
All right. Okay. So gross rent multiplier, gross debt service ratio. They're only looking at the new purchase of the property and what it's going to cost to manage it, not to exceed as a standard 32, exception at 34, and 39 if I put down 20% and pay the CMHC. Correct?
Correct.
Awesome. Okay. So let's go now. Now that I've met the requirement of GDSR, now there's TDSR. Let's talk about that.
So it's everything that's in the GDSR ratio, and then we add all your other debt. So
Okay.
just because you qualified under the first stress test, the GDSR, you also have to qualify under this one. So they're going to take your credit cards, your student loans, your car payments, and any other revolving debt. They don't care about your Rogers, your cell phone, your groceries, or any of those utility bills. They just want any revolving credit, right? So you got to throw that into the mix, and the maximum that you can spend on all those things combined is 44%. Right?
So 44, and this
Percent
is
of your income. Of your gross
Okay.
income.
of my gross income. Okay, so if I max that out, then I'd be looking at 44 plus 39 max,
44 in total.
including. Oh, my
Yes,
apologies.
yeah.
Yeah,
So
you're
this
right. That
just
makes
all this
sense.
does basically
Just
we've given you an extra 12% for credit
I
cards
see.
and debt.
That's makes sense. Okay, that's right. Obviously, I was putting the numbers together. I was adding them up. Like that's impossible. Okay, so exactly. That's actually the best way I think to put it is the difference between the two. So if I'm at the standard 32, an additional 12% of my gross income can be allocated to these extra things: the revolving credit cards, and lines of credit, and obviously non-revolving, like a car loan, right? The car loan or any student loan, which is non-revolving because I'm just paying
Right.
it down.
We take those at true value. So if your car loan's
Real-
$300 a month,
Yeah.
we'll add $300 to your GDSR, to your TDSR.
Right.
Okay.
Okay.
Whereas with your credit cards, we're not going to use your minimum payment as the amount for the calculation. We're going to just use a standard flat 3% of your balance monthly. So if you have a $10,000 credit card bill, 3% of 10,000 is $300. We're going to do $300 a month on
Right.
that, right?
Right.
And whereas the minimum payment on that, so $300 a month, you're talking $3,600 a year,
$3,600
right?
a year.
Your minimum payment's not $3,600 a year on a $10,000 credit card.
No,
right?
no.
It might be $1,000.
Right. But okay,
So
so
we're going to take 3% as the minimum,
3% is the minimum.
and we do that on lines of
Will
credit
they?
as well.
Will they? So that's the standard. 3%.
Standard,
So they're not going to come back and say to me, "Well, you pay $1,000 on this credit card. That's the fee."
So what we can do, if your ratios are, let's say they're at 48%,
Yeah.
if you can pay off one of your credit cards to bring it down, we'll say,
Often
okay,
used as a tactic to get you.
yeah, we'll say, hey, you're at 48, 60%, 40%, we'll get somebody to pay off your credit cards, or pay off this, or pay off whatever it is you can pay off, just to bring it in line.
What about the just talking about credit cards, walking into the bank, which has happened to me, and I'm sure other people, where they talk about releasing some of those credit cards. Now we don't like doing that. We like the access to capital. We know there's part of the strategy is to do more business with the bank after you get the loan. But if I have $100,000 available credit, I'm not with zero balance. They're still tacking on 3%. Is that correct?
Some lenders, yes, some lenders, no.
Okay.
Some might ask you to lower the limits. Some don't say anything. I had one client just recently has a mortgage with a lender, did a secured line of credit with another lender on the mortgage, and they forced him to reduce his credit card limit from $22,000 to $4,000.
To meet the requirements of that loan.
Exactly.
The second loan.
The secured line of credit, correct.
So the second loan was a second institution.
Right.
It's the second institution that told me I had to do
that. They went so far as to write a letter to the credit card company,
ensuring that it's been reduced.
Ensuring that it's been reduced.
Or that they could even ask you to close it right out.
Well, they'll never leave you without a credit card. Okay, so they'll
tell you to leave. They'll tell you
to keep
one.
Yeah, they'll tell you to keep one.
And then as soon as you get the loan, they'll ask you if you want some credit cards from them. Right.
That
line of credit from them.
Yeah, and what happens? You have to remember, after the mortgage or the secured line of credit, you can go back to any of those institutions and just start rocking up your credit again.
Right.
They'll give you access to all that stuff.
Now, we were talking about this last week. You mentioned to me that the practice of having a second mortgage with a second institution is pretty much dead now. Is that right?
So the only lenders that I know that do second position mortgages, the second position lending, are Manulife Bank, National Bank, and they'll do it with the intent or the hope that when the first mortgage comes up for renewal, that you take that business over to them.
Right.
There's no rule that says you have to.
Right.
But that's the expectation. Now there are B lenders and C lenders that'll do Equitable Bank and First National. They'll take second position on their non firm loans.
Right. These are secured loans, though, right?
Right.
And the first position lender, really, obviously, their first position has no effect on them.
Correct.
Because they're getting paid first anyway.
Correct.
Right?
But the banks won't take. Your traditional banks will not take second position on a loan that's not theirs. On a mortgage that doesn't belong to them.
Right, a line of credit. Right.
Whereas the past
secured line of credit, where the past there was no big deal.
Right.
It was no big deal. So these are the major banks you're talking about.
Correct.
Right? Okay.
But Equitable and all these other lenders, they'll do it all day.
Right.
But in terms of the Tier A ones, National Bank and Manulife, we consider them a Tier A.
Right.
They do it.
Right. Okay. Cool.
And they're good because they don't charge appraisals, they don't charge legals. They'll do the whole deal for you for free.
Oh, really?
Oh, yeah.
I had a student last week that was talking, and I don't know of anybody that doesn't. Obviously, residential appraisals, you mentioned for appraisals. Typically, the institution that's issuing the loan or qualifying for the loan, they'll pay for the appraisal because they're doing it because it's in their best interest.
The Tier A banks, the B lenders no.
Right. B lenders won't. They'll make you get.
Typically, they'll make you pay.
And there's probably some additional fees when we're dealing guaranteed with B lenders because it's almost you're going into I don't want to say private because it's still institutional money. It's just B lenders.
But they're taking on additional risk, and they're not necessarily charging you that much more of an interest rate differential.
Right, but they want you to pay for the cost of vetting the deal.
Right, and they might even charge you, an A lender wouldn't charge you for a mortgage statement. These other lenders might charge you $100 a year for a mortgage statement.
Oh, okay.
So that statement that you get every year that tells you your balance, that costs you $100.
Really? Okay.
Right.
Well, I mean, if really, it all goes into the cost of the transaction at the end of the day and the cost of the interest. Okay, so What about commercial though? Is what I really wanted to ask is, I don't know of anybody. I paid for my own commercial appraisers. Do you know of any lenders that actually would pay for the commercial
Appraisal?
appraisal? Yeah, no, it's just
No.
not
And a
doesn't
lot
happen.
of commercial lenders are now asking uh, for a fee up front so that you're not shopping it out after you get the rate from them.
Oh, really?
Yeah, because they're spending a lot of time underwriting these deals and putting the
Right.
deals together on the commercial side that they're asking us for like a retainer.
Really?
Yeah.
Wow, that's new. That's wow. Okay, all right. Okay, so going back just to wrap up with TDSR, so now we're adding, so the difference between the GDSR and this, that extra 12%, if it's 39, it's an extra 5%. How often do we breach that 44%? Does that happen often where they allow you to go above 44%? No, that's kind of like the line. There's no special exception typically, right? You're not going to see that.
You might be able to get away with, 0.5%, 1%.
Right, right. Okay, okay. And that's where they're looking at my debts and stuff
That's
like
easy to
that.
that's easy to correct. That's why they don't, right?
Right.
The GDSR, you want the house, you're up by 1%. Well, you can't really go
You
out and buy a
can't
different
change your
house.
income. Your
You
income's your
can't, right?
income. Right.
Whereas with this,
I could
save
reduce.
yeah, we'll
I
save
could
money for a few
reduce.
months and pay off some credit cards.
Right, right. Okay. And could I get the money for anywhere to pay these down? They don't care. It's the down payment
As long
that
as
they
they,
care
as long
about.
as they don't see it.
Right. And the down payment is what they care about. Right.
Correct.
Okay. All right. Okay. Now let's go credit reporting agencies. We talked about this last week. We
Perfect.
talk about this a lot. Credit Karma, Borwell, use Equifax and TransUnion. I don't know if any of you heard Capital One had a breach. And actually, I saw an email from Borwell telling me that they were secure. And, I mean, the security issues really is not my point here is staying on top of your credit and your credit history, knowing that whatever's on your history is accurate is important because you want to know your credit score before you walk into the institution so you know that you qualify when they run it. Because when they do run it, Tark, obviously that I'm going to be hit 2 to 10 points or something like this on my credit report, right?
Right.
Okay. Mortgage underwriting, income verification, types of acceptable income, down payment rules for providing improved credit score analysis, property assessment. We talked about all these. Tark did about all these. We talked about the underwriters and them making sure that you meet the requirement. Again, that's really for I don't want to overstate it, but mostly it's for the insurance companies, right? They're meeting the requirements of the insurance companies because if they can't insure it, like we won't, we can't get financing for a house that can't be insured. They can't give you a mortgage unless it's met the requirements of the insurance company to be insured. Then we have the mortgage programs. We talked about the Alt-A self-employed program, stated income programs, newcomer programs. These are now available. It's becoming more and more competitive as the years have gone since the last crash. It's recovered quite well, to be honest. In a short period of time, there's a lot of competition for your money. Interest rates continue to stay flat or even might go down. They're talking about the Fed tomorrow, the Federal Reserve for the United States dropping a quarter point or a half point off their rate. And typically you'll see that Canada somewhat follows that lead. So it'll be interesting to see how they respond to it, or even if they cut rates. I don't know if you know that Canada's banking system, Canada was one of the banks that the EU has banned from accessing capital. Most recently with four other countries, just because their banks do not meet the regulations for accessing that capital. Now, I don't want to get into that story. You can look into that. It's not a big deal. It just means that the liquidity of the Canadian banks or how they're managing their money, because everyone talks about how great our banks are. They're not meeting the requirements of the EU, which is their requirements there, which really I'm not going to get deeper into because that's more of a trading thing. You know that I invest in markets also.
Did you want to talk about the new CMHC incentives?
Program, yeah. Can you talk about that?
Yeah, a little
Okay,
bit.
great. So let's talk. We're going to talk. Okay, any questions about this stuff here? Any questions? Okay, we're good. All right. So with the last little bit, you're all good. Good. All right. Let's talk about Target, if we could, the new program that the government is implementing with the equity sharing, I guess, and interest-free loans. Can you talk a little bit about that?
Yeah, so I'm not sure if it's been approved or given us a date yet,
Right.
but the program basically talks about CMHC kicking in 5% on resale homes and up to 10% on new builds, on new homes, first time buyers only, So they're willing to kick in an extra 5%. So if you're going to put down 5% on a mortgage, let's use a $100,000 house, for example. You can find a house for 100,000 just to make
Right.
the math simple. You've saved $5,000 and you're a first-time home buyer. CMHC will kick in another $5,000. So you've got $10,000 as a down payment versus five. That down payment that comes from CMHC is deducted off the balance of the mortgage. So
Right.
you carry a mortgage for 90,000 instead of 95.
Which allows me to I can buy more
You could buy more house, and if it's a new home, they'll kick in up to 10%. So if you're putting down 10%,
and that goes straight to the GDSR. Really, that's what's being affected, right? The GDSR is what's being affected, right?
you could borrow more money.
Because my mortgage payment has gone down because I went from 95,000 to 90,000, so my GDSR dropped from 32 to say 30, and they say, well, you can be pre-approved for more money.
That's right.
Okay.
The other good thing is, I mean, this is it's kind of free money because they're giving you 5% or 10%. They get to participate in the
increase,
the fluctuation of the value of your home.
Right.
They participate on both ends.
But yeah. But as I understand it, and you're alluding to this, and this is your point, I'm sure. Is if your house goes up 50,000, if they put up 10% equity position, they get 10% of that proceeds.
They get 10% of the sale of the home.
The profit.
You got the sale of the home.
The sale of the home.
That's right.
Really?
That's correct.
That's not good.
What do you think they're going to get? 10% of their initial investment?
10% of the profit.
No, if they're putting in 5%, they want 5% of the value of the home.
Let me see if that makes sense here. I guess that makes sense because they put up the money. They get their money back plus the profit. That's what they're getting, right? So wait, let me think about this. Give me a second. 100,000 goes up. They put up 10,000. 100,000 goes up to 200,000. They make
10%.
20 grand. No, that makes sense. That makes sense to me. Yeah, that makes sense.
Now, the flip side is,
if they take a loss, though,
they take a loss.
Yeah. So if the
property
value doesn't move or goes down, they
get 10%. They get 10% of whatever the value of the house is.
Whatever the value, which makes sense now. That's much clearer. Okay, yeah, okay.
That's my understanding.
No, that's right. No, that makes sense. That makes sense. As an investor, I would want the same thing. The investor would take on the same thing, except, and this is the big deal, there's no interest on this. There's zero.
There's no interest on their portion, correct?
Their portion. There's no interest. So it's an interest-free loan, equity position, risk position that they take, and it was funny. I was talking to Adnan about this, and he couldn't get his head around the idea why the Canadian government would do this. He thinks it's crazy. The Canadian government would take the risk of it. Why are they doing it? And my thoughts are, I'll share is simply this: they're really I think they're worried about the market. These new rules with the new stress test rules, they hurt the market so bad that they use this to instead of taking it out of the way, right? Saying, "Oh, we were wrong. We should," they put this new program in to offset the stress test rule, because basically this kills the stress test rule. Right. It kills it, right? That percentage, the extra 2% that you had to qualify for, they've taken it away because they're putting up the money. So I mean, that wipes out that whole program, and really, apparently, and I was reading up on this a little bit too. The real focus is not only new first-time home buyers, but new homes. They're talking about
so this is first-time buyers on new homes or resale.
Yeah.
But you have to remember, because the Canadian housing market has seen such a dramatic increase in the values of homes,
right?
It's taken out a lot of potential buyers. So the millennials that are looking to buy homes, they're out of the marketplace now. They can't afford them.
Yeah,
they can't afford the homes anymore.
Right.
This is designed for them more than anybody else.
Right.
It's the first-time home buyers.
What about the builder's piece? Like, I mean, it looks like it really feels like a builder's bill. Like somebody, the builders got lobbying for this program because for them, it's huge. I don't know if it's true that we need inventory, more housing inventory. And my big belief is when the government gets involved, typically they create they take away predictability, which creates a problem. And this is where the market can be taken advantage of. What do we have here? But they would get their 10% back even if you sold same year and no increase in price. They would get their 10% back even if you sold. What? So no, actually no, they wouldn't.
Why wouldn't
They
they?
wouldn't get their 10% back
Why wouldn't they?
because if the house sold for less, they'd
They're
get.
still getting they're getting 10% of the value.
Oh, yeah.
It's always 10%
That's
of
the
the
point.
value.
Yeah,
Yeah.
right. That's absolutely right. Yeah. I
You
mean,
know,
10%.
you know, it's a
They're
good
not getting
question
their
though.
money back. If it's their loss.
Here's a good
Yeah.
here's a good question though.
What?
What happens if you buy the house, you don't sell it, and it's your principal residence, and then you pass away, and
And the
it's
estate.
and then no, if it's your principal residence, and you gift it to your child, well, I guess so on death, it would be a deemed disposition
Right.
at market value
Whatever it
to
was.
your
As part of the estate,
not necessarily as part of the estate.
probate, as part of paying an outstanding bill that has to be paid by the estate.
Well, no, the home can bypass probate and go right to the kids. But what would happen is it would be deemed disposition. The kids, well, the kids wouldn't pay any taxes because it's principal residence. So that's something we'd have to look up and maybe get back to.
Okay, all right.
Okay,
That's
but
a
it's
good
a good question.
Yeah,
Right?
it is. It is how far it goes. Okay, and you know the other thing I wanted to talk about, and I don't want we can come back to that at another meeting. Yeah, just before you go, I really know that and I really appreciate your time. I thank you
Don't know
very
what
much.
it's saying.
I just wanted you to talk a little bit about as much as you can, introducing the idea of shareholders insurance and the importance of that in our corporations.
So I've worked with Dan on a couple deals.
Yeah.
They, they weren't for real estate, but
Right.
basically, um, whenever you have more than one person getting into business, so when you have partners in a business together, you should have a buy-sell agreement.
Mm-hmm.
And in the buy-sell agreement, there should be a piece that talks about what happens in the case of a death of a partner
Mm-hmm.
or the death of a shareholder.
Mm-hmm.
You know, what happens to their shares and how does and how you could use life insurance to fund or to provide the funding mechanism for that exchange.
Right.
So,
So outside, and this is outside, obviously, of spouse, right? I mean, this is an outside partner, right?
correct.
So I have a partner. I have a business partner. We're 50-50.
Me and you get involved. We buy
Yeah.
$1 million plaza. I own
Okay.
50%. You own
We're
50%.
and it's in a court.
And let's say 5 years later, let's say as part of the buy-sell agreement, buy-sell agreement states that I can only sell my shares to you, and you
Right.
can only sell them to me.
Right.
If something happens to me, you have the right to buy the shares from my spouse. So my shares flow through to my spouse.
And now
My
the
spouse,
insurance,
my spouse will then
the
present the
endorsement,
shares to you,
Right.
and you will have to buy those shares. Now, you don't necessarily want to sell the plaza to buy the shares,
Right.
and you don't necessarily have $500,000 sitting in a bank account.
Right.
So you use life insurance as that funding mechanism to provide the cash in exchange for the shares.
So this is life insurance on a shareholder.
Correct, as part of the buy-sell agreement.
Right. So the insurance is going to give the capital to the company to
Mhm.
buy the shares back from the spouse or whoever it
You
might
got
be
it.
the kids that got
Right.
but and they're forced to sell those shares. That's part of the buy sell
As
agreement.
if it's in the buy-sell agreement.
Right. I mean, you could write anything in the contract, but typically that's what it's there for is to
Right.
get the money. The company has the money to actually afford to buy the shares back.
Right.
Right. Okay.
Without having
all
to
right.
liquidate the assets.
Right.
Right.
Right. Which
Because at that point, the spouse may or may not want to be in business with the partner.
Yeah,
Right?
100%. And you want to be able to give the spouse or the family those proceeds.
Right.
You want to be able to get.
They want to realize the value of
Yeah,
their
that's
shares.
right. So if the plaza that we bought for $1 million is now worth $10 million, and it's worth, say it's completely paid off and it's $5 million, I want to be able to give them the $5 million. Like you said, if I don't have the money, the life insurance will provide that money. And the insurance premiums on a product like that for a corporation, because
It's standard life insurance.
standard life insurance, it's
You
just
got
the
it.
corporation is paying for it, and obviously this is the right.
Yeah, there's some pretty sophisticated ways though. If you're a corporation that doesn't necessarily have the cash flow to pay for those premiums, there's ways to borrow the money from the insurance company to pay for those premiums. Okay, so let's say for example, yeah, it gets a little bit complicated. We'll touch on that next time.
Yeah, well, next time we'll
Okay.
talk about borrow the money from the insurance company. I like that. Okay. Okay. So anything else about the corporation? Obviously, the insurance, life insurance for shareholders insurance. Anything else? I know. Is there anything else that you deal with in the corporations with the corporations? in the protection.
I mean, we do Keyman life insurance, Keyman disability and critical illness insurance,
Right.
partner buy sell life insurance.
All paid by the corporation,
All paid by the
which is a
corporation.
huge deal, right?
Correct.
And there's another program we're not going to get into now. We've been talking about where, based on income and the amount of money that we can get the corporation to pay for that insurance with the tax rate off. You know what? We don't. Let's not get into it. Okay, it's something more complicated, but there's if you make a certain amount, once you start making a certain amount, Tarek was talking to me about. Let me say something about Tarek. Extremely creative, which is one of the things I love about him. Finding a way to get it done. Definitely someone who finds a way to get the money to make things fit the rules that are existing and making sure that you meet those requirements. So. Awesome to have you. Thank you very much for your
You're
time.
welcome,
Really
Sam.
appreciate it.
No worries.
Thank you. All right, folks. It is 5 minutes left. I'm gonna wrap it up. Is any questions? Real questions? Because Tarek's he's got to leave us now. Is there any other questions you wanted for Tarek, real quick? That was great, by the way. That was awesome. Yo, they want your contact info.
Okay, so I'll put my email.
Okay. Do you want to type your emails in there? Okay. So this is what's going to happen. Tarek's going to put it in. Now again, I want to make this clear with Power Team members, my Power Team members. I like people to talk to them about, actually, if you have general questions, I want you to reach out to me. But if you're looking to actually get something done, do some business, then I want you to reach out to Tarek. Does everybody understand that? So questions, I'm happy to get them. If I can't answer them, I'll reach out to Tarek. But I don't want to bombard him with questions. Obviously, he's running a successful business, and I want to make sure that his time is taken care of. Okay, so definitely, I'm happy to take on those questions. Is that right? Okay, there's his email address. You can grab that. All right. Okay, folks, we're gonna wrap it up. Thanks again, Tarek, for coming out and sharing your time with us. Hopefully, we can get you out maybe sometime next month, do a little revisit. Is that okay?
Sure.
Awesome. Just to keep us abreast of any changes that are happening in the marketplace. I'm sure everybody here appreciates you spending your time. Okay, folks, we're going to wrap it up. It was a great session. If you're good, type in. Okay, we good? Everybody good? Okay, I'll get this recording up for us relatively quickly because it was great content. I want everyone to have a great week. If you need anything in between, you know how to reach me. Everybody have a great week and happy